What is up, all you real estate loving individuals? This is episode number 35 of the Real Estate Take podcast, and I'm your host, Wendell Butler. It's your go-to podcast with tons of information regarding the current real estate market. We get various real estate professionals' current take on different areas of real estate. For today's guest, we have Scott Carson. Scott Carson is a highly sought-after guest and host of the popular podcast, The Note Closers Show. An active entrepreneur, he is an expert in real estate investing, raising capital, and marketing. He speaks regularly at different events and industry conventions focused on real estate, marketing, and podcasting. He also helps thousands of investors and entrepreneurs each year create wealth through his debt buying classes, podcasts, and coaching. An avid sports fan, he spends his free time traveling, gardening, and making memories, and he calls Austin, Texas, his home. So let's introduce Scott. Scott, how are you doing today?
I am doing great, buddy. Glad to be here. Excited to share.
Awesome. Yeah, and I love that you do something that we haven't anybody on really talk about, buying debt and like trading notes and things like that. So that'll be really cool to get into because it's a subject that people don't really know about. They don't really understand, and they don't even understand like how you make money on it because they're like, you're buying a note. Like, how do you like squeeze out like money there? Like, what is it, the long game? Can you make quick money? So it'd be cool to dive into it. So I love just starting off with just getting to know you more. We heard your bio, but I'd like to just get a little bit into your backstory, kind of who you are, how you got into real estate investing, and particularly note and debt buying, and you can take it from there.
Yeah, so I started like many folks, graduated college, was working a great job, making good six figures, and read Rich Dad, Poor Dad. And I was like, oh yeah, this is great. And of course, I was married at the time. We liked to watch that fictional TV show on A&E called Flip This House. You know what I mean? Where everything is completely accurate. You know what I mean? So decided to buy our first house. We did that. Our realtor was like, you guys have great scores. This is going back to 2001. And they're like, you should buy a couple other investment properties. Great time to buy. I was like, yeah, sure. I could fix everything. I grew up in a small town and dad owned a local hardware store. So I fixed a lot of stuff. I was pretty handy. And my tools like, yeah, I'm going to be the next landlord for sure. So we bought 2 investment properties, 100% financed. And then in 6 months, I became a distressed borrower, as I like to say, because I got laid off from my job. Yeah. And then my 2 tenants got laid off from their job at a computer company that rhymes with hell here in North Austin. So I was distressed, was able to get rid of the 2 investment properties and save my home basically the day before it going to foreclosure. And so I was like, screw this real estate stuff. I don't like getting kicked in the teeth. I don't know about you, but not the great way you want to start off with things. So fast forward a couple of years, I was back in finance, got into banking, and then a buddy of mine approached me to start a mortgage company here in Austin. I was like, well, that's what I like to do. And then his sponsoring brokers were 2 people who had traveled the country teaching creative financing, owner financing, buying terms, creating debt, and then also buying notes from banks. I was like, ooh, this is pretty cool. I think I want to do that. And that was back in 2004. And fortunate for me, for like the next 4 years, I had a apprenticeship with Bob and Jamie, not only originating hundreds and hundreds and hundreds and hundreds of mortgages for real estate investors, making good money do that, but also sitting through all these conferences and all these seminars on real estate investing and taking all this free education and started dabbling in real estate myself, doing some auctions, wholesaling some properties, some light fix and flips and doing some of that stuff. And then when everything hit the fan in 2008, I said the origination side, bye-bye, and then started buying notes directly, started, making phone calls each day, 50 to 100 phone calls, like a stockbroker, but calling banks and lenders to find out what kind of bad debt they had in the books that they were looking to get rid of. And that was the thing that I fell in love with. I was able to get a couple lists in from like Wells Fargo Financial and Banco Popular, and some of these bigger banks were just like buying anything. So I bought like my first note for $500 and flipped it for scrap metal the next day for like $1,500 in Detroit. Bought a little small note in Jacksonville, Florida for $4,000, got under contract and flipped it and made a $6,000 wholesaling fee on it. Started getting other lists from in like Wells Fargo multifamily and a 75-unit apartment complex, Arado, that we were able to wholesale. And they got this huge listing from Capital One, and I was like, this is exactly what I want to do. So I basically stopped doing every type of other real estate investing and focused solely on note investing because I started getting so many lists in and started teaching because most people don't understand what note investing is. I think you're buying the property or not. We're actually buying the debt and becoming the bank. And now fast forward, it's hard to believe that was 15 plus years ago when I bought my first note. And now we've bought over $1 billion in debt and thousands of deals all across the country and just about every type of residential commercial property you could think of. So that's a little about me being the note guy and buying debt.
Yeah. And I always tell people, like, I started to go back to like where you got started kind of in real estate and just learning and stuff. You got into like the finance portion of it. So like originating, lending, stuff like that. And that's where I got started too. And I think that what people forget about is they always think they got to go like the realtor, real estate agent route or just go straight into investing. Like I think personally, and just from my experience, like becoming any type of originator just to understand loans, what banks are looking at, how they underwrite stuff, etc. It sets you apart down the line because now you have like a bank mind. So no matter what way you go into real estate investing, like whether it's Airbnbs, whether it's long-term rentals, whether it's fix and flip, etc., like the most important part of it is financing. So if you understand that and have like a super like deep understanding of it to the point that you already have like a conservative mindset going into every deal of how to underwrite, and you take emotion out of it because it's just numbers, like it really sets you apart. And also as you're working there, I mean, you're getting paid to learn everything because you come run across everything. And I'm sure you learned, it was almost like going to college, but they're paying you to learn about everything, right?
That's totally what I say. It's like a 4-year apprenticeship to learn creative financing. Besides just the traditional bank financing and mortgage, I was learning how to structure deals, how to set things up with owner financing, the hard money side of things, private money side of things, and how to really kind of structure things to make things, to create win-win solutions. And then also having the ability to learn about the note business, because a mortgage note is basically when you're trying to get qualified, it's like an origination package, a qualification package. Well, I can read paperwork now really easy because basically when I buy distressed debt, it's like a dequal package. You know what I mean? And so, yeah, I totally agree. The money is always in the money and then the numbers, if you can figure things out. And it sets you heads and shoulders above your competition who's just trying to figure things out. Only thinks like, oh, I've got to have all the cash, or I can only get a loan from a bank turned me down, so I can't do this.
Yeah, because there's so many options out there. People think you can just go to like one bank for it, but there's so many creative ways to work. There's other lenders that are more creative. They have different terms, different loans. And you can really like spread your ability to buy or invest in certain ways if you understand that. And then also just it allows you to be quicker and faster. So the real estate market, it's all about speed when you try to get a deal and try to purchase like a note, try to purchase property. And if you can walk a property, like understand what it needs and just understand the terms like the back of your hand, if a bank would even lend on it, you can say yes or no real quick. It's important to get to that yes or no like as soon as possible, right? And people get caught up kind of just underwriting, trying to make deals work. But with that lending background and understanding of finance, you can quickly be like, nope, yes. And then you can work on that one and it saves you a lot of time. So then you can have a velocity of capital moving just so much faster, right? So let's dive a little bit into more in depth of like buying notes. So like how the heck are you making money buying notes? Are you finding, let's start in the beginning. Like when you first started, obviously you had to target smaller amounts of notes, right? Because I assume that you have to either raise the capital to purchase that note at like a discount or whatever, because they just want out their books. So just give us an idea of like, do you make like a spread on buying the note and then you like can work with the borrower and like how does that work? There's so many different options that you can make money from notes. I just want kind of like a broad understanding so our listeners can not get too confused,
totally.
you know?
Exactly. Don't know. I like to talk and are you smarter than a kindergartner or smarter than a fifth grader kind of knowledge? So here's the thing. That's the question. How do you make money in notes? Especially my niche that I target as non-performing notes. Okay. So first of all, a non-performing note is somebody who hasn't paid their mortgage, usually in at least 90 days. I prefer 6 months or longer. The more months they haven't paid, really the more motivated the bank or the lender is to offload it off their books, because especially if it's a bank and they're holding on non-performing notes, that affects their ability to lend that money out on a monthly basis. And if it's an FDIC bank, they've got to hold money back in reserves to qualify for the FDIC insurance and things like that. So by buying a note, we're literally buying the debt, not the property. That's one thing. Now the note controls the property. So this is physically what I'm buying. I'm holding up a collateral file on a note that we bought a few years back. Okay. But this is what we're technically buying. Is this paper controls that $85,000 property in Kankakee, Illinois on this one. Okay. So the way that we make money is when we buy non-performing notes, we actually prefer it occupied. And I want to go to the borrower and not rehab the property. I want to rehab the borrower. Like, okay, Wendell, you haven't paid your mortgage in 2 years. What the hell happened? You lose your job, you get sick, divorced, mama got run over by a reindeer, something like that. Can you start paying? Were you out of work? Can you start paying? I know that, okay, you can. What can you bring to the table? Most of the bigger banks are going to want you to bring the full amount that you're past due on, which is 2 years. Most people don't have that money sitting on the sidelines, right? Otherwise, they'd have paid. So can you bring 3 or 4 months to the table of your back payments? Great, you can. Okay, can you pay $100 extra per month? Great. Well, let's do that for a while and then see if you can do that for 12 months. Then we may modify the terms of the loan and what you owe. So let's just keep it in simple numbers. $100,000 mortgage, let's say it's at a 6% interest rate or 7% now. If they haven't paid in 6 months, I might buy that note probably at 50 cents on the dollar. The house is worth 100, they may owe 110 because they're behind, but I bought it at $50,000. Now, if I can get them just to start paying on time and it's a 6% return, interest rate in the note, that's a 12% cash and cash return to me if they start paying on time. Yep. If I have them bring 3 or 4 months months of payments to the table, that may go to 12 to 20% ROI in that first year. And that's how we make our money, is the cash flow side. It's all about cash flow. And then after 12 months of on-time performance, that note is no longer non-performing. It's now reclassified as performing. So I could turn around and sell that on the market or sell it back to banks or lenders at, say, 80, 90 cents on the dollar. So I get a little bit of lump sum on the front end, monthly cash flow, and then a bigger check in the back end. And now if the borrower chooses not to pay, guess what? I bought that note at 50 cents on the dollar. I'm the bank. I have the same rights that a lender does. I can foreclose. And now I can sell that thing at the foreclosure auction for 80, 90 cents on the dollar, or I end up taking it back and then either selling as an REO after some cleanup or whatever the condition of the property is. We don't like to do a lot of heavy rehabs, but I like clean cosmetic stuff, paint, carpet, appliances, maybe exterior paint, stuff like that. There are times we'll buy stuff that we have to do some extensive rehab to, but most of the stuff, it's usually pretty clean because somebody's been living in it, taking care of the property for the most part. So that's kind of our strategy. I mean, there's different strategies on how we work with the borrowers. Like we'll do a short sale or cash for key, so avoid a long foreclosure time frame. We'll even let the borrower, if they've got somebody that wants to take over the payments, take over subject to, we'll allow them to do that, or allow them to do a settlement, like a partial payoff. There's a whole variety of ways that we can skin the proverbial note cat in a lot of cases. But our biggest goal is to turn into cash flow. Does it turn into cash flow? Then we look to try to liquidate the property without foreclosure. If they won't play ball, then we foreclose and make money that way.
So like when you buy these notes, right, say like you're calling these banks, and again, just for our listeners, like banks, they don't want to foreclose and they don't want to hold properties because they want those off the books. Their whole game plan is to lend out money and make interest on that money. And that's it. They just want consistent 6%, 7% returns. And that's why, Scott, when you call them, probably they just are like, there's certain ones that are on the books. They're like, yeah, we got to get these off because they have to get them off because it's just red. And they have quarterly meetings or whatever. And I guarantee you, like the president, vice president, whatever, the banking is like, we got to get rid of these freaking loans, or we got to foreclose them and figure it out and get rid of this, sell this property. And they don't want to deal with the selling portion because it's just a headache, right?
Well, you know what you got to keep in mind here. Let's clarify a little bit of stuff for your audience out there. You're not going to call Bank of America, Chase, Citi, Wells Fargo and say, hey, I want to buy your non-performing notes. I mean, you're going to have to write a $50 million check to get anything from them. Yeah. Okay. You're also not going to walk in your local branch and say, hey, I want to buy your notes. They're like, we don't sell them. Every bank has non-performing notes, basically. If they don't, they're not lending on enough. So what you do is you're not going to the local like retail branch or calling customer service. You have to track down the internal departments in this, and they go by a couple different names, like the special assets department for your major institutions, your secondary market, your chief credit risk officer for smaller banks, your secondary marketing departments, even REITs and lenders out, big insurance companies and real estate investment trusts have departments called whole loan traders, where it's that person's job just to move the non-performing stuff off their books. And you're exactly right. The banks will put out quarterly FDIC reports that you can see that have to disclose how much in non-performing note they have, how much is 30 to 89 days behind, how much is 90 plus days behind, how much is commercial, how much is residential. So it reads there, the quarterly filings reel is kind of like a treasure map, a treasure trove of who's got stuff that you can take. And then it's all about following up. You know, there's no direct mail. We're using LinkedIn, email, and then the old-fashioned 1,000-pound phone a lot of times, $1 for dollars and all that stuff. But the beautiful thing that I've always loved about notes is it's different because let's flip the other side around. Most retail real estate investors are targeting lists like a foreclosure list or an absentee investor list or something like that. You know, driving for dollars and looking at the ugly house. Well, they're competing with a lot of people and they got to send out a lot of direct mail a lot of times, door knock or stuff like that. Once I started getting lists sent to me on a regular basis via an email blast, or once I got on a bank's buyers list, I was just blown away that they would send me every month or every quarter just lists that might be anywhere from one asset all the way up to 1,000. Yeah. And that's the thing I love is getting this list, and then I don't have to buy the whole list too. I don't need $5 to $10 million to do this. I can cherry pick, buy a one-off note, or I could buy 10 notes. I can make offers on 50 and maybe 25 get accepted or countered, and on that 25, I may end up with 5 after going through the due diligence process. And then of course we've got to raise capital for this 5 because you're not often get a bank to finance a non-performing note to you unless it's a commercial asset. And so then you're raising capital from investors and going that route. Yeah.
So to break it down like Barney style, I feel like it's like, say you're like a fix and flipper and you're trying to buy distressed properties that are, once it's done, it could be worth like $300,000. But right now, because it's crappy or it needs a lot of work, it's worth like $150,000. And then if you buy and put in like $50,000 and put some time into it, whatever, you can sell it for $300,000. If you look at notes the same, it's almost like you're fix and flipping notes, right? So it's like you're finding notes that have a value of $100,000 once they're performing, right? But then you reach out to those credit departments and the people that are looking to offload those, and you're like, hey, we'll get this from you for like $50,000. They're like, okay. And then you either work with the borrower or you can foreclose them yourself, and then you got all the equity that's in the property. And then if you have a fix and flip company too, you could just flip it and you can double dip right there as well, which is really cool.
Yeah,
right?
I mean, the thing is that the value of the property really doesn't change that much. We're buying it as is. You know what I mean? We're not looking at after repair value. So that's one of the big things they're going to do. Diligence is making sure that property is a good value that we can buy off of. Usually we're buying mortgages where they owe more than the property's worth. I mean, we'll even buy mortgages where there's equity. We don't get that equity. We're only going to get basically the balance of the note. So we'll buy stuff sometimes at 60, 70, 80 cents of what's owed, knowing we've got this chunk of equity that will probably either get paid at the auction in a month, 9 months, or if it doesn't sell at auction, now we just have gotten all this equity because the bank foreclosed and nobody outbid us at the auction.
Yeah. So like when you buy the note, just as listeners understand too, it's like, say the note's $100,000 and you pay $50,000 for it. That note is still $100,000 to the borrower. You just got it for $50,000. So you technically have the $50,000 of note equity in there that they need to pay on, right? So you make that's where the math was coming in of you saying, 6% at 100,000, we pay 50,000. That's
the 12% return.
So then you just double it. So then you make it 12%.
Exactly.
And then if you front load and say you got to catch up, you get even more. So then it's like 15, 20% returns. And then when you go around and sell it after you repair and fix the loan so it's performing, then you get 90% of that note, which then that split is like you make like 40,000 on top of that, right? That's amazing. So like this process when you purchase the note to like when you say it goes perfect, right? You purchase a note that's $100,000, $50,000, you help the borrower start paying, and then you flip the note at the end. Like what's the process timeline and like how long does that usually take? And like how much should you, if you're interested in doing this, like how much free money should you have to be comfortable during that process? Because I'm sure it can take a year, sometimes a year and a half, but some can be really fast, I feel like, right?
Look, so states have two basically foreclosure timeframes most of the time. There's a lot of states that have fast foreclosure timeframes, which are non-judicial. It means you don't have to go through a court system. Basically, you file or publicize the notice of default after 90 to 120 days of non-payment, and then you're foreclosing at the foreclosure auction. Like here in Texas, we foreclose the first Tuesday of the month. So as long as, if I'm buying a note here in Texas and the borrower hasn't paid for 90 days, as long as I go down and file it 21 days prior to the first Tuesday, I can go to the courthouse steps and sell it at the auction. Judicial states like Illinois, Florida, that could take 12 months to 18 months, sometimes faster, but usually we budget for about a year or more on a judicial state. And so then you got to go through the court systems and hire an attorney to foreclose. I mean, you have to hire a real estate attorney anyway to foreclose, but it's then going through the judicial process of foreclosing, getting your mid-summary judgment approved. So it can take a little bit longer for that. I don't mind buying in judicial states because you get a little bit bigger discount because it takes longer to foreclose as long as the lender hasn't already done like 9/10 of the list, gone through the process. There are a couple states we avoid like New York, New Jersey, because it can take 2 to 3 years to foreclose in those states. We avoid litigious states that aren't very lender friendly, kind of like the West Coast, California, Oregon, Washington State, stuff like that. So, but we still buy in about 20 to 30 states, and we can tell a lot through the due diligence process how likely is that borrower to get back on track based on looking at the notes from the servicing company, the call logs from the borrower into the lender. So that gives us good fit, sending somebody to drive by the property, see what kind of condition it's in. I mean, we're not getting interior access unless the borrower's got the property listed for sale or it's like a vacant property that we're buying the note on from HUD and they've already gone in and changed the lot. So that sometimes we get lucky with that. Most of the time, we like to buy occupied assets because somebody's living in the property, taking care of it. It's not going to be too much work. Our goal is not to end up with the property. It's literally, like I said, to be the bank, hold it, and go from there. So once you get that borrower making that first payment, get back on time, it's usually a countdown clock of 12 months. And the reason we also wait 12 months before we sell the note as a reperforming is because if we sell before 12 months, it's a short-term capital gain tax on it. So we always like to hold stuff for 12 months or longer. And then that way it's going to be based off the underlying interest rate and what the unpaid balance is. And we've gotten 90% of the unpaid balance before selling the reperforming note. There are funds looking for 7, 8, 9% return. So we might discount it down to however we need to hit that 9%. It also varies too how much skin in the game the borrower will bring to the table to reinstate. I mean, we've had anywhere from 4 months, usually is what we ask, up to like 50 grand to 100 grand in a lot of cases to reinstate the loan. So just, depends on a borrower by borrower basis on what we can sell it for. But then we'll market it to IRA investors who are looking for performing notes, mortgage funds, even Wall Street people will buy performing debt for their books as well because the borrowers obviously put some skin in the game into it. And they've proven track record of paying on time. I mean, we leverage a third-party servicing company too is important for like 25 to 95 bucks a month, depending on the asset, to collect and keep track of those payments and making sure that they're licensed debt collector because most states require you to be a licensed debt collector to collect on debt. And if you use a third-party servicing company, it keeps you from having to go get the license yourself. Yeah.
And that's not that big of a fee, I feel like, for like really taking your mind off of dealing with that. Because I feel like that's kind of like a little task or a minute. I mean, it's a biggest thing getting paid, obviously.
It's called delegating, you know what I mean? If you do minimum wage jobs, you're going to have a minimum wage bank account. So paying a servicer $35 to send out statements and track it all third party and then even be that filter between you and the borrower so that there's not too many cooks in the kitchen. When the borrower has an issue, they're calling the servicing company and you're getting the same answer, not trying to play you versus the servicer versus the foreclosure attorney.
Yeah. So when you buy these notes, or even when you first started, did you only look at real estate notes, or were you looking at like car loans? Were you looking at all different types of loans when you get started? Because like to find like a $4,000 note on a real estate property, if you want to dive into it and start, I feel like that's a little difficult to find to some people.
No, it's not. I'm sorry. I'm going to contradict you here because you got to realize we're seeing stuff all across the country. And what market do you live in, Wendell? Where you
in Charlotte, North Carolina.
Okay, Charlotte, North Carolina. Median home value there is what, about 450, 400, or 300, somewhere like that, right?
I think it's up to like 425.
Yeah, it's similar here to like Austin. So, but there's a lot of other properties out there too, all across the country that have values of 50K or 75K or stuff like that, or mortgages that have been around for longer than a month or two that have been paid down. So, like I just got a portfolio in of 95 notes that have balances under $50,000. That where they got, usually most of them have 50 to 100 grand in equity above it. So those are pretty secure notes. If we buy them, that either A, we're going to get paid off in full, or the borrower is going to start paying to avoid them losing their house and all this equity foreclosure. So we see stuff like that happen. There's also a lot of smaller owner finance notes that you can purchase too, land loans, stuff like that. So finding small amounts are not, I actually don't like targeting small notes for the most part because I get a bigger bang for the buck. On the bigger stuff, I want a $5,000 paycheck, not a $50 a month paycheck, if that makes sense.
Yeah.
So, but they're still feasible. But the great thing here too is the money question always comes, what should you have as far as savings to do this? We've got people like my buddy Phil out of Canada. He invests here in the United States. He put 500 grand of his own money to work and got rock and roll. And then I got another buddy, Cal, who didn't have any of his own money to start off with. And he went out and started buying these reperforming notes at a 17 yield or greater. And he would just raise capital and give 8-9% to his funding partner who was using their IRA for 3 to 4 years. And he's holding that for performing paper and stuff like that. So I always say those folks that come to the table that have capital is a good thing, but it stops them from going out and marketing for money immediately. And I think that's one thing we as investors always have to be doing is marketing for private capital. And the sooner you do it, the more deals you find. Biggest handicap we always see is investors using their own money. And then when they run out of their own money, they sit around waiting for a deal to sell off versus going and marketing. So it can put them, months behind somebody who didn't have any money to start off with. If that makes sense.
Yep, exactly. So when you look at these properties, do you have a certain criteria based on just the property? Like, do you buy mobile home manufactured homes, multifamilies, or is it really just single family homes you're looking for?
Great question here. Yeah, we try to narrow it down. I mean, I always recommend people buying in cities that usually have at least 25,000 to 50,000 population or greater, because that means there's plenty of buyers, plenty of realtors, plenty of handyman to help you out with the product. If you're buying something in a city of only 500, you kind of have a limited buyer pool and a rehab pool, you know what I mean? But yeah, usually most of what we're buying is single family homes, 3-bedroom, 2-bath, 3-1s. We'll look at a lot of condos depending on where they're located. We bought a lot of multifamily too, commercial notes as well over the years.
No, I'm sure those are ramping up a little bit too, right?
Oh my God, we're seeing a lot. The thing is, on the bigger units, like the 100, 200 plus, the banks, when they're way up, probably way upside down, they're not looking to sell that debt right now at a discount. Most of them are going to go ahead and foreclose, and then they either are going to put in management to manage it and hold on to these assets for 2 to 3 years till the market kind of evens out a little bit. But here, like come Tuesday, though, there's over 4,000 units from one fund going to foreclosure in Houston. Over $1 billion in multifamily going to auction. What happens to those properties? Who knows what will happen with them? I mean, either the banks will take them back. They're probably not going to sell them at the auction with the mind that they're just going to operate these for a while and go from there. But like I got in a tape as a spreadsheet, a list of notes of 20 multifamily loans, anywhere from like a 5-plex in Chicago up to like a 78 unit apartment complex in Indianapolis that the lender was willing to sell these things because the borrowers haven't paid in 12 months. These notes, these mortgages were mezzanine loans that were all purchased basically 2, 3, 4 years ago. And some of these smaller investors got caught up in the rate hikes and stuff like that. So they can't refinance out. And that debt is at an 18% default rate. Yeah. So buying that, if we can get the bar back on track, it's a great thing. But most of us are probably going to take these over, buy them at a discount, 50, 60 cents on the dollar, and then either work with the borrowers to walk away and then regentrify the asset and hold on to it for a while.
That's awesome. That's cool. I just had a question that just popped out of my mind. Oh, yeah. So like when you buy these notes, right, you're buying the whole note, you hold up that binder, right? Now, when you purchase that note, because the borrower signed that note, like you have to follow that same note kind of terms, right? Or can you start readjusting it to help rehab the borrower kind of, or do you have to stick specifically to how that was written?
Great question. So what we will do is once we buy, it takes about 30 days for the transferring to take place from the previous owner to us, and then from the previous seller's servicing company to our servicing company. And the first thing that servicing company is going to make right party contact with the borrower and say, hey, what's going going on? What happened? Can you start paying? Can you reinstate the loan? If you can't, then what can you pay? We do trial payment plans a lot of times, and we don't permanently modify the loan. If you permanently modify it, it changes the terms, the interest rate, payments. I don't permanently modify. We always do trial payment plans for 12 months because this gives the opportunity for the borrower to come to the table and do what offer them. I can always foreclose. I'm not going to give them something that they couldn't go get themselves. So I'm like, listen, if you make payments on time for 12 months, then we'll adjust the balance. Then we'll reduce the interest rate. I mean, I can still say your normal payment's $800 a month. Well, for 6 months, let's do $500, and then we'll bump it up to the full payment. So we can get creative in working with ways to make it a win-win. Most importantly, it all depends on how cheap I buy the note at. You know what I mean? Like, we've had people that literally say, okay, you're behind by $5,000. Can you bring $2,500 to the table? Yep. Bring $200 a month. Great. For every $200 extra you bring, we'll forgive that same amount on the balance that you owe. So to help kind of dangle that carrot in front of them, and after 12 months, we'll drop your interest rate from 9.9 to 7 or 6 or something like that. So yeah,
that's awesome. And it seems like you're in the game of wanting to help rehab these borrowers and make them pay. And the reasoning behind that, I would say, just from listening, is you want the cash flow right off the bat, right? You don't want that just sitting there and then immediately foreclose. So, because like people might be listening and be like, why don't you, if you buy these notes for 50 cents on the dollar, why don't you just immediately foreclose? And I feel like the reason behind it is because you want that cash flow to go, because then you're going to flip the note anyway. So you're going to get the cash flow plus flipping that note, and ends up being just a higher return of investment doing that by far anyway, because if you foreclose, you're going to deal with legal fees, waiting, you're not going to pay anything, taxes and stuff are accruing. And I feel like the government just takes, when you sell it, they just take whatever is from the tax interest, right? So like you want all that to start getting paid. And that's another side question I'll ask, but can you touch on that a little bit?
Yeah, that's a really good question. I always say the biggest mistake I made was my first 2 years as note investor was trying to foreclose on everything. So then I'm paying servicing costs and attorney fees and dragging this stuff out when I probably could have reinstated or modified a bunch of them with the borrowers, gotten cash flow, no legal fees, and then no rehab costs as well, and made money without ever having to foreclose and own the asset. So yeah, looking back, numbers don't lie. Our biggest bang for the buck is actually keeping people in the property. Now, don't get me wrong. There's times we buy debt knowing we're going to foreclose. Like, we're going to foreclose on this guy because he's played every type of game in the book for the last 4 years. You know,
you have the notes from like their conversation with the bank.
Exactly.
So you can tell like, oh, this guy's not going to work with us.
Yeah, this guy's full of shit, basically, or he's lied about that he speaks English, or he's dying of cancer. I mean, I've heard every sob story in the book out there. I can't pay my mortgage. Oh, really? Based on your social media profiles, you should have bought a brand new car. You know what I mean? Or hey, on your Facebook, you said you were going to go to Disney World versus paying your mortgage. I don't feel sorry for you. I hope Goofy can house you for the next 6 months. You know what I mean? Yeah, I mean, we like to help people because I have that empathy from going through the same thing years ago. But I don't run a charity. I run a business. I can be a person's greatest asset, and if they'll work with me, but if they won't work with me or they lie to us, look, homie, don't play that, baby. Homie, don't play that. You want to stay, you must pay. Pay, stay, brother.
Yeah, and I'm sure like you've had a lot of instances too where like the borrower is just thankful that you guys worked with them and helped them, because they probably, when you start getting foreclosed on, it feels like the world's ending, right? And you're like, oh no, and then you just end up not doing anything because you're like, I can't do anything. But when you come in and you buy the note and then you start talking to them and say like, hey, let's try to like work and get this better, I'm sure a lot of them do appreciate that. Do you find that? And is that like fulfilling? Like, that would be fulfilling to me for sure.
It's very fulfilling. I mean, there's times, like, I'll give you an example. We bought a portfolio of notes, included one little shitty house in Cleveland, Ohio. The borrower owed like $40,000. It maybe was worth $25,000. Yep. And as we're looking into it, we find out it's a single mother of 4 kids, right? And we see her hardship letter. She's trying to go to school. She's trying to raise her kids, and that's why she's not able to pay. So we only bought that note for like $2,000. I'm like, like Christmas, we literally sent a letter out to like, listen, we're forgiving you of your debt. You own your house now, free and clear. Merry Christmas. We wrote off the $2,000 we paid. It was a win-win. I didn't want to own that asset anyways in a rough part of Cleveland, so it was a win. And there's another time like we get a portfolio in, and we see this one note with his bar been trying to do a loan modification for 4 years, and her mortgage had been sold 4 times. And the reason she couldn't pay is because her husband had a heart attack, was out of work. Yep. And they'd raised their 3 daughters in this house for 18 years. There's a lot of emotional equity wrapped up in the walls of this house. Owed 60, house is maybe worth 35, 40. We bought it for 12. When I get on the phone and talk to her, I don't talk to a lot of the bars anymore, but I'm like, listen, I see your struggles. I see what you've outlined. You can start making your existing payment again. Great, let's do that. Can you bring any money to the table? She's like, yeah, I can bring $2,500 to the table. I'm like, great. Can you pay $200 extra a month on top of your payment? She's like, yes, I can do this. Okay, if you do this for 12 months, I paid 12 grand for this. If you figure 2,500 plus 600 some odd dollars a month times 12 months, I basically made my investment back in that first year, right?
Yeah.
So after 12 months, she paid on time. We dropped her interest rate down to 0% from 9.9, and then forgave her about 20 grand in upside down. She owed 60. The house, we revalued it. It was like 40. I said, okay, now we'll drop your rate to 0, but you still make your $400 a month payment. You'll have your house paid off in 6 years versus 30 years. And that was a great story. Found out her and her husband cried when they met with my attorney there. Sent us a postcard. They ended up naming their first granddaughter Carson after me.
No
because
way.
they were able to, yeah. I mean, so you get a lot of good people, because let's just face it, most Americans, it's a dream to have a house. It's a dream to own your own house. Most people are not unethical. They just want to work. They want to put a roof over their head, and they want to do the right thing. Bad things happen to good people all the time. So it's just kind of, what can you do? I mean, there's times like, listen, we'll give you cash to walk away. You literally can't afford this house. You just can't afford it. Let me give you $5 grand or 10 grand. Like, we just worked with a student of ours who just gave the borrower 75 grand to walk from a house.
Yeah.
She couldn't afford it. She was elderly. It was too big a house. Could she have sold it and gotten more money? Yeah, she didn't want to sell it. I mean, it needed some work. She didn't have the money to do the upkeep. So she was glad getting 75 grand to walk away and let somebody else take over the property and deal with that. And that's a win-win. And that's what we always try to say. I mean, if you're a real estate investor, you try to create win-win scenarios as best you can. And if a borrower will work with us, we'll work with them and help them out. But then you have the same people like, I'm glad I foreclosed on this asshole who lied and said he had cancer. There's a special place in hell for some people like that. You know what I mean?
Well, sometimes too, you just got to teach that person a lesson, because then they'll realize what they did and hopefully they learn from it, right? Because some people just don't learn until it actually happens, because they don't believe that it can happen. They believe that they can keep cutting corners, but then it's kind of a good thing. It's like a moral good thing that you did it, even though it's like kind of a shitty situation, right? But for those people, you almost have to do that to kind of show them that you can't do that. It just doesn't work.
And that's the thing too. There's people that get into this and they want to talk to borrowers. They want to do work. That's great. A borrower who's behind, people do stupid things in bad financial situations. If a borrower does not make a guideline, a dateline request, like, hey, you got till the end of the month to send us trial payment plan in your first payment. That doesn't happen. Like, listen, I'm offering you a get out of jail card here. If you don't want to get out of jail, I'm going to foreclose, and I'm not going to waste my time. I'm just going to kick to my real estate attorney, and you can try to talk to him, and that's not going to be a very good thing. So that's the thing you have to be. You have a heart. We have a heart by modifying people in the house, but you also run a business.
Yeah.
And I've seen investors too, like, they get into it, and I'm like, well, why haven't you foreclosed on this deal? They haven't paid you in 9-10 months. Oh, we want to work with them. Like, shit, did you not talk to them 9 months ago? Yeah, they're working on something. Like, look, do a cash for keys, deed in lieu. You ain't got to foreclose, but you also have to take initiative on this stuff. Otherwise, you're going to be the distressed borrower getting your house foreclosed on if you don't watch it out.
Yeah. So let's talk a little bit about, I want to hit on that one question that I had before. Then I want to talk about cash for keys as well, because people might not understand what you mean by that. So, because the cash for keys for rentals and stuff, it's kind of similar. So when you buy these properties, they're behind on their mortgage, obviously, and they're probably behind on taxes too, and they probably aren't even paying their insurance. So with the taxes and insurance part of that, how do you facilitate that as well?
Great question. I'm glad you asked, because that's one part of our due diligence, is looking to see how much are in property taxes and how much are behind. Because if it goes to tax sale or tax survey, it can wipe out your mortgage. So that's part of your due diligence on the front end. If they owe more than the current year's back taxes, we'll actually ask for a discount on our bid to pay off those back taxes. So we try to make that a wash. But there's times that they were behind, and we actually worked with the bar. Called the bar, said, listen, call the county and work out a tax plan with them, payment plan. A lot of them will do that. Or like, you can't pay your taxes. Okay, we're going to pay them, and now you're going to start paying back $200 extra a month to pay back the taxes. You know what I mean? If you're not going to pay that, that's a default. We have the right to foreclose. Same thing with insurance. People are supposed to have insurance of the properties. We check that. If they don't have that, we'll put what's called forced place insurance. That protects us too when we're buying the notes, because we don't get into your access. So we always put forced place on unless the borrower shows that they have proof of insurance. Yep. But there's been times we bought notes and then we opened up the property, the condo, it's got mold everywhere. Well, that's an insurance claim. We'll file a claim to protect our assets, and they'll cover that. And so we double check those things. We can also, when they're not paying, we'll actually put that on ourselves, and it's an extra fee that the servicing company will cover through their blanket portfolio, or we can take out individual policy. So it's not as difficult, but it's still important to know what's going on with an asset, especially some states are really difficult. Like Florida, the property insurance will kill you a deal. Anywhere from 10 grand to 30 grand. We've had it triple on most of the properties we've held there for a while. And there's even a lot of insurance companies that will not insure there on an investment property. So we used to buy hundreds and hundreds of properties down in God's waiting room. We haven't bought so much more. So you just got to keep that in mind. And now that's become a big thing. Like, okay, I'll buy this asset, but I'm dropping my bid. What normally would be 100 down to 70 because of the insurance costs. If you're not going to play that ball, then we're going to walk and move on to a different asset.
Yeah, because it's hard costs that you have to have insurance on the property, because if you have a note on it and there's no insurance and then it like catches fire, you're like, okay, my money's gone. It's just gone.
Yeah, we've had that happen before. I mean, that's why servicing companies so valuable, is because when you have somebody who has insurance on the property, you're named as the lender. You know what I mean? So if they stop paying, you receive a letter, hey, your borrower stopped paying on their insurance in hurricane season or flood season or tsunami season, like I guess California and Hawaii are dealing with in the last 24 hours. You want to make sure there's stuff on it. You know, make sure it's not in a floodplain. If you're dealing with like in Houston, it costs more there because of all the hurricanes, and heck, Houston floods and it just drizzles most days anyway. So
so that's super important. So you do, like, if you buy a note, sometimes you will just like pay the insurance out of pocket just to have it there, but then you try to get it back paid from the borrower, and then with your trial payment plan, right? And same with taxes.
Exactly. And if we don't see it and they prove that they have insurance, we can always send that proof to our insurance company, and then they'll credit back that month that we paid in advance, stuff like that.
That's awesome. So yeah, because like one of the worst things you can do is forget totally about taxes, right? So say you bought a note and you just totally, for some reason, you just didn't even think of the taxes, right? How fast does the government just be like, hey, we're foreclosing on this? And then how does the money get divvied up once they sell the property or take it over? Are you just screwed? How does that work?
So that's a really good question. So some states are faster than others. Most will not foreclose until it's like 3 years behind. They'll slap a lien on it. They'll notify you. But if it gets more than 3 years behind, then they're going to start a tax foreclosure. Some states,
the liens are expensive usually, right? They like the interest on those liens are high.
Yes. I mean, exactly. You're paying distressed debt, your late fees on the taxes. Some states are tax certificates. So like Florida, if you're not paying every year, they'll auction off or sell off that tax certificate. And once you're 3 years behind, who paid that tax certificate has the right to foreclose and wipe you out completely.
Yeah.
You know what I mean? In some states, there's a redemption period. Like here in Texas, it's a 6-month redemption period for farmland, or a year if it's a homestead. So you can come back and pay off the full balance, but you're paying, like you said, an 18% or 25% interest rate from day one on the amount that they paid on the taxes. So that's something you got to keep. It's a little bit of due diligence on the front end side, but how it works, and this is a funny story too. So if the county is foreclosing on taxes due, and they say they owe $5,000, the house is worth $100,000. Well, they'll send it to a tax auction, usually the same day as normal auction, and you'll have a crier come out there, the sheriff say that $5,000, and investors will bid that up. Well, if they bid that up, say to 70%, that's $70,000 they bid up because the house is worth $100,000. Well, $5,000 goes to county, and then another $65,000 sits there at the county waiting for either the lien holders or the borrower to claim them. And so we'll buy notes knowing they went to tax foreclosure sometimes, but there's a big tax overage waiting for somebody to go claim it. And so all we do is we'll buy that note and say, oh, it went to tax foreclosure. We'll give you 5 cents of the dollar for it, knowing that there's $65,000 sitting out there. And then we just say, okay, then we've got to send in a payoff statement and assignment of mortgage showing that we now own that debt, and we'll file a claim at the county, and the county will pay us.
Yeah.
You know what I mean? So some states it's first to claim. I mean, if let's say the borrower only owed $50,000 on that deal, well, $5,000 went to the county, $45,000 would go to the first lien holder, and then anything over that $50,000 would go then back to the borrower or any other second lien that was filed against the property.
That's cool. Yeah, because people are always afraid of the government. Government always gets their money. I can tell you that. They will always.
Government, and that's the thing. We always ask, what can wipe you out? Taxes and God. That's why we pay our taxes and check the taxes and put insurance on the property.
Love it. Cool. So cash for keys I want to talk about too. So you're talking about these cash for keys instead of doing like a foreclosure. Can you just explain that a little more, and like maybe a situation that you had it happen and why it's beneficial to go that way rather than just doing a foreclosure, and vice versa? Maybe there's some situations where it's better to do a foreclosure. Can you just talk about that?
Yeah, exactly. So when you're thinking about doing like a friendly foreclosure, cash for keys, you always got to look at two things. A, what's owed on the property. So if I hold a first lien mortgage and there's a second mortgage on the property, I'm not going to do a deed in lieu or cash for keys, because if I accept it, that second isn't going to get wiped out. That second now becomes a first lien position. Mm-hmm. So in that consideration, I would then do what's called a consent to judgment, where the borrower signs off on consenting to the $100,000 that I owe, and then I can take that in front of a judge and say, okay, they consented to the $100,000. Let's finish the foreclosure to wipe out the second.
Yeah.
And sometimes I'll call the second mortgage company and say, listen, I'll pay $1,500 for your second, because that's what's going to cost me to foreclose you out, or $2,000 or whatever.
Yeah.
You can either get something or get a whole lot of nothing. If there's no liens, you're always going to check title. So if there's no liens on the property, then you would do like, okay, there's no liens, there's nothing behind me. If there is some fees or something like that, we'll go ahead and pay that. But we'll go ahead and give you $5,000 to sign the property over today and what? Now in Texas, it doesn't help because it speeds it by 30 days. But like a state like Florida, that can speed you up taking the property back by 6 months to a year in a lot of cases. So that's you talked about velocity capital. Okay, I'll give you $5,000 because that's what it would cost me to foreclose, to take the property back now. You're out. I can fix it up, sell it, and be out of the property. And the thing too is a bargaining chip when you're educating a borrower if they're there. It's like, listen, makes sense for you to work with me, because if this goes to foreclosure, it's going to be a negative impact on your credit for 7 years. You won't be able to get anybody really to finance a house with you. If you do a deed in lieu, I'm going to forgive that debt. Okay. You're supposed to file a 1099 to them so that they can go pay taxes on that debt forgiveness. But if they can, I think it's IRS form 928, they should be insolvent. They won't pay any taxes on that forgiven debt. And that's a great thing for them. But then they're only delayed by 24 months or when their last late pay was filed at the credit bureaus. So that's the thing I can say, listen, if you'll do cash for keys with me, you'll be out of this property. We'll forgive the debt. It'll show like you paid off your mortgage. That's a good thing. And in 2 years, you've worked on your credit. You can go buy a new house and be in a better position.
Yeah.
You don't have to have this hanging over your head that you can't afford and they can screw everything up. Let's get you in a good situation. If you got some equity, let's give you some cash to get out of the situation and move, put you on your merry wing. Like I said, we've done anywhere from $500 to 75 to 100 grand for cash for keys before as well, depending on what the borrower situation was.
Yeah. And there's always people in real estate that are investing that are like, you're going to give them money when they're messing up. It's like, hey, yes, if it speeds up the process and you make even more in the back end, absolutely. Or if you just even make a little bit less, but you don't have to go through the foreclosure timeline waiting, that's higher return of investment.
Everybody always talks about ROI, return on investment. Return on time, the ROT is even more important than return on investment. How soon can you get in and out? I mean, if I'm going to make 12% on a property, it takes me a year to foreclose and flip. Great. If I make that same 12% in 6 months, though, my annualized return is actually 24%, and my time is a whole lot better spent because now I can do 2 deals a year or 3 deals a year versus that one deal that takes forever and drags on.
Yeah. So the average, just to hit these two numbers, just so people listening can hear, it's pretty awesome. So the average like cash or cash return you can get, say if it's like a 6% note and you buy 50 cents on the dollar, that's about 12%, depending on how you make your trial payment thing, right? Throughout. Now, if it works out and like after 12 months, you can then flip that note, then you get that extra boost of let's say 30, 40K, and then you're looking at almost 100% returns, right? So like that's where like it gets really sexy with the numbers, right?
Yeah, that's when it gets really sexy that you can make 20, 30, 40% on a deal and never have to rehab a property or own it. You're just literally the lender. And you bought, let me give you a great example on a deal that I'm actually buying right now.
Yeah.
It's in Toledo, Ohio. The borrower owes 106. The house is 110. I'm going to buy that note. And the interest underlying note on is at 8.9%, right? The seller who's selling the note needs to sell it. It's actually a private seller. They're willing to sell the note at like $45,000. So if they just keep making their monthly payment, it's a 23% annualized return for me on my 45, 46, yeah. You know what I mean? Because they're just paying. If I hold on to that note for 5 years and the borrower refinances me out, I'll get another $50,000, $60,000 on top of that cash flow in the difference between what they owe and then what I bought it at. You know what I mean? So, there's always like 3 paydays where they say a little bit of cash on the front end side from them reinstating monthly cash flow, and then you just get a big payout, whether you're selling the note off, they refinance you out, or say sell the property, you get paid off the back end.
Yeah, I didn't even think about that because you can get them paying on time. And then do you ever like let the borrower know or send them like little tips being like, hey, you got a lot of equity here, you should refinance out? Because then you can refinance to another loan. You don't have to try to sell it. You get that difference of like paying off that loan, right?
Exactly. I mean, it happens. I mean, with rates being there right where they're at right now, you're not getting a lot of refinances. But when things were like at 2%, we have people refinancing out quite a bit. And that's a win. But I'm like, shit, now I got to do something with that money. And you put that money back to work. You got to work it back again for me. I mean, it's a positive thing when somebody refinances in a lot of cases in a better spot. But the things that we look at, like, okay, I know I'm going to hold on to this note because it's at 9%. I'll probably hold on to it for 3 to 5 years. Then a logical person would refinance it because the rates drop or they got all this equity they can tap into.
Yeah.
And so that's one thing we've aligned with a couple, I won't say credit repair companies, but something like that. Hey, you may want to talk to this guy about refinancing you. I mean, we bought a performing note one time from this lender that was going out of business. They lost the whole collateral file.
Yeah.
Right. I couldn't foreclose if I wanted to. And so we reached out to the bar and said, listen, if you refinance, we'll forgive you 20% of what you owe. So they went and refinanced. And I'm like, oh, thank God. Because if we'd had to foreclose, we wouldn't have been able to.
Yeah.
You got to get creative in a lot of the cases. And so that's all. And all it does too, if you get somebody that's not paying, like we had a deal in Houston where the collateral file was just complete gone. My servicing company had lost it. And so we actually didn't pay the taxes because we were wanting to force a tax for sale. So I had my attorney show up and bid the tax sale up at the auction above what was owed so that we could claim an overage and never have to foreclose. It took a little bit longer than expected, but we got a little creative that way. And it still was a very positive deal, even 3 years after the fact.
That's awesome. That's so cool. Yeah. I didn't really even understand buying notes too much. And you just made it clear as day. And I think I'm going to start looking into it for sure.
It's right. You know what? You're in a state, South Carolina, we see stuff. Yeah. Now, South Carolina's a judicial state, the 1-year foreclosure process. But if somebody's occupied, they're behind, you buy at a good price. I mean, okay, this person is behind, they lost their job, they're back to work. They're probably a logical place to reinstate it, or we're buying stuff that they're already 6 months to 9 months through the foreclosure process, we'll hold on to it for another 90 days and be in and out of it. So, yeah, I mean, that's the great thing. If I see something in South Carolina where I'll shoot it over to you and hold your hand through the process. You know what I mean?
Let me know. North Carolina, South Carolina, send it on over.
There we go, baby. Exactly. Now, North Carolina is a fast foreclosure state. It's non-judicial. The thing about North Carolina, though, it has that upset bid thing at the auction. So you have the auction, somebody bids on it, the county gives like 30 days for somebody coming in and the thing up at the auction trial. So that's a good thing. It also drags things out, but it works in our favor in a lot of cases because we're getting higher bids for the most part.
That's cool. So for someone, just to start wrapping this up, because you're a busy man. And
well, you got a closing today too, buddy. So you got something that's more important. That's awesome.
So I always like to ask these questions, just people that are super interested in buying notes, which after hearing this, I don't know who wouldn't want to learn more, right? What are like the best resources that you've like books or podcasts or anything that you've utilized to learn as much as you can, be more effective or better at note buying? And just when you started too, like what are some things that look out to for education just to get a better idea?
Yeah. So we started a couple years ago during COVID, we started teaching a 3.5 hour like Cliff Notes class. It's free. It's called Note Weekend. If you go to noteweekend.com, you can watch the replay. We just taught it like last Saturday, or you can sign up for the next time that we do it live. We do like once a month live, but it's free. No credit card or name, just your name and email and phone number. And then you'll have this 3.5, 4 hour class, which we talk about how we find and fund and flip these deals. And then of course we have a longer 3-day workshop. That's $500 to $1,000. It's live with me teaching for 3 days. But we have the Note Closing Show podcast. This is our bread and butter podcast coming up on 1,000 episodes next week. That's free. Our YouTube channel, WeCloseNotes.tv, is the number one YouTube channel for notes. We go through all sorts of case studies and tape breakdowns and all that stuff. But today is a very special day. You didn't know this, Wendell, but over the last 2 weeks, I've been taking my mind and all my content, Vulcan mind melding it with AI. And so we launched an AI clone this morning that you can go to for free and ask me questions about note investing. And it's pretty freaking cool. So it's like Delphi.ai or Delphi.com/Scott Carson. If you want the link, shoot me a message at Scott@WeCloseNotes.com. But that's there for people to have a resource to go ask questions 24-hour a day, 7 days a week, 365 days a year to help you on your investing journey.
Yeah, and I'll be sure to put that on the bio as well for people that are listening, just so you can easily get access to it. Something just popped in my mind before we try to close out with some closing questions. I'm sure you can you wholesale notes? Like, if you found someone that's like, hey, we'll sell this to you for like 50 cents on the dollar, and you're like, well, I don't want to deal with this. I'm going to go try to wholesale this for 70 or 60% on the dollar. And then you just take the difference. Like, how would that work?
Yes. The answer to that, yes. It's just like wholesaling a piece of property. The big thing you need to know is the value of the property. There are people that will just get listed and be a joker broker and blast it all out trying to get people. That's not an effective way. That'll get you blacklisted really, really fast. Yeah. But yeah, there's been times we'll get a tape in. I'm like, okay, this deal is at 40. Hey, I know that Wendell likes this area. Hey, Wendell, this is a deal for you. We're having under contract 40, but we'll wholesale it to you for 50. Yeah. And hold your hand through the process. But yeah, it happens. The bank doesn't want to know you're wholesaling. A lender, they prefer that they're dealing directly. But once they get a wire, they don't care where that wire comes from. Yeah. You know what I mean? The only issue is you might do a double closing. If I didn't trust you, Wendell, like I think Wendell's going to go around me and try to go direct. Well, then we would do like a double closing like it would any wholesale deal. But most of the time, it's like, okay, sign my wholesale agreement. Okay, we're going to give you the due diligence docs. You're happy. You're going to wire to the bank, and then you're going to wire directly to my escrow account for my fee. And it's the bank may say, well, we have to issue the assignment, the transfer docs into Scott's name. Okay, that's fine because that's what the contract said. We'll turn around and create another assignment that goes from my name to your name, and then you'll go file 2 assignments of the county records to transfer the note ownership to you directly. But yeah, wholesaling, it's all about knowing what's in the deal. Is it a good deal or a bad deal? And knowing what we're going on. I mean, if you're going to spend that time wholesaling, no offense to wholesalers out there, I love you, but you do all this work to create a buyer's list. If you put the same marketing, same effort, you can create a funders list and raise a ton of capital, especially like targeting like self-directed IRA investors at the county record. That's free in a lot of cases. And now you've got a buyer, somebody who's got money and somebody who's pulled the trigger. And notes are great for IRAs because they're passive. And if somebody's using their IRA, they can't touch it. Got to be passive return. That's why about 40% of all IRA funds are in notes. The self-directed IRA funds are in notes.
Love that. And I always like to ask this last question. I know you talked about like your webinars and your websites and stuff. We can get tons of information. But do you have like a book that for people that just love to read?
So what was his name? Jimmy, the art of financing or note investing. The guy passed on a couple years ago. I mean, we've got a couple ebooks that we send out as well too. But it's such a niche out there. It's what is it? Power compound interest or note investing by I've got it on my bookshelf here. I'm sure I can find it somewhere. But yeah, if you just Google note investing books on Amazon, there'll be a couple that pop up that will be good for you, stuff like that. I mean, that's the thing. It's such a niche within a niche out there. My niche of buying distressed debt has been around forever, but it really became popular back after 2008, 9, and 10. Oh yeah, when you had much more opportunity companies, and the banks couldn't sell everything just to Wall Street, or Wall Street wasn't buying.
Well, and right now it's pretty hot, I bet, because the economy is really hard right now. Prices are absurd. Everything's going up, and there's a lot of people that do need help in those areas. So
let me share something with you. We do a lot of tracking for this economic wise. When we track, we have a report that comes in from 855 cities in the country, the biggest 855 cities. Okay. On average, it's going to be a 10 to 20% decline in value in the next 12 months. Sometimes up to 40%. Okay. Like Cape Coral, Southwest Florida is seeing a lot of that right now. People still they can't sell. I mean, you got contracts being canceled left and right because people can't get qualified or they can't afford to sell it and show up with money at closing. So there's a lot of distressed debt. I mean, we've been talking this we see stuff 6 to 12 months ahead of time. It's a beautiful time to be a debt investor these days.
Yeah, I love it. All right. So let's wrap this on up. I always like just give you the floor at the end, just to anything you want to tell the audience, like social media handles, if you run meetups where you are, or business events or charity events, anything like that, or even where to contact you. The floor is yours.
Thank you. Well, the most important thing that you guys can do, Wendell is doing a kick-ass job here. Okay. And he needs help golfing, obviously. So best thing you can do, go out there and leave a 5-star review on this podcast and leave him a little testimony why you love what he's doing. I mean, we as podcasters love to hear from our audience. So go do that for Wendell here. He needs it. He needs that positive reinforcement that you're listening like we all do. All right.
Yes.
But the best thing that you do to find out me is just go to weclosenuts.com. You can always book a phone call with me at talkwithscottcarson.com. But we are here to help you. Like I said, check out that free class, our podcast, the Note Closer Show. Honored to be here. Thank you for having me, Wendell, and just a blast the last hour has been.
Yeah, thank you so much, Scott. This is a subject I've always wanted to talk about. Not a lot of people do it. Like you said, it's very niche, or they just don't talk about it. So it's amazing. It's a different side of real estate that people don't realize. And I love it. So I'll probably be in touch with you for sure, because I want to get into it. I've always thought about it, and it just sounds really cool. And I love finance. As you know, lenders from the heart, right? That's where we started. So we're like, finance.
That's right, baby. Sharks in the water. When there's blood, there's sharks in the water, buddy.
Awesome. So I'll put all Scott's information in the bio, everybody that's listening. Yeah, it was great having you on, Scott. And thank you all for listening.